I want to take you through the probably worst situation I've ever seen a client put themselves in. And there's good takeaways from this, I think, for everybody. This person in particular was a business owner. What they did was they would go out and they would look for businesses. This is really popular right now, where people are looking for cash flow businesses. And he said that one of the better cash flow businesses in his portfolio were car washes. And it kind of makes sense to me because if you go to a car wash, like we have a monthly subscription to a car wash here, and there's like a little sticker in the window. You pull up, arm opens up, you drive through, like very little overhead, machinery, and all the normal stuff, water, et cetera. I don't know if they own the dirt underneath them or the lease or whatever, but very little overhead, a lot of cash flow. So he had a lot of different companies in his portfolio as an entrepreneur. And so he loved car washes. He said that these things are just, they print money. And so he went out and he bought another car wash. It was actually a couple of them. He bought a couple car washes, but let's just focus on one. And it was doing great. So he bought it earlier in the year, obviously the winter time and salt and stuff like that. So just pumping through. And then the local economy got a little soft. And it was turning into the summertime and springtime. And yeah, I mean, people go through it, the pollen, but not at the same clip as they were going through with the salt on the cars and stuff. And so, the cash flow on the business dropped significantly. And so he sold it. He told me he sold the car wash, right? He bought it early in the year when it was doing great, whatever the price was. And then he sold it when the revenue was down. And so when we were talking, I was like, man, that was a quick turnaround. Did you make money on it? Like I was assuming he made some money on it. He's a smart guy. And he's like, no. I had to sell it at a loss because look, the recent cash flow and whatnot. So yeah, we sold that at a loss. All right. Didn't really make a lot of sense to me, but okay. I mean, this guy knows what he's doing. So we were doing a review later in the year and we're talking it through and I was going through the different positions that he's got. And there's the car wash, the same car wash. And I'm thinking, no, I missed something, right? And so I asked about it and he's like, oh no, we bought it. We bought it back. So I'm thinking, okay, there must've been a great deal, right? There had to be something. I remember you might've seen the story in the news where Barstool Sports, Dave Portnoy, the guy sold that business for, I don't know, some ridiculous sum of money. And then he bought it back for $1. I don't even know why. I just, now he's worth all this money and buying mansions everywhere. So I don't know, maybe this guy was doing something like that. No. That's not what he did. He decided to buy the car wash back because we were coming into wintertime again. And, he was going to see the cash flow again. And I'm like, okay, so is this a buy and hold? He's like, no, I'm probably going to sell it again in the springtime. So I had to understand this. Like, okay, you bought it at X at the beginning of the year. You sold it at less than X because it started to do poorly cash flow wise. And then when it started to do well again, you bought it at a higher number. And then he's going to sell it again for a lower number later. And that just isn't making sense to me. I don't know if that makes any sense to you. And he's just going to continuously go through this. And the truth of the matter is none of that's actually true. That totally made up story. Why am I doing this? Why am I bringing up this story? Why am I making this story up? That's what a lot of newer clients or people I haven't worked with before. And honestly, even some of my more experienced clients, that's what y'all want to do with stocks. That's what you want to do. That's what people do. If you look at the research, there's a company called Dalbar. And I'm not going to quote the exact number because I just don't have it on hand. But they've done, and I think Morningstar's done this. I think Vanguard's done this study too. And then what they'll do is they study like what average market rates of return are. And they'll come up with some percentage. And then they'll study the average investor and what returns do they get. And it's always significantly less. And again, I'm making these numbers up, but if you go and you research it, you'll find these numbers. It'll be like the market returns, say 10%, and the average investor gets like 3 or 4. And they're not, it's not from a fee perspective. It's because what they're doing is they're buying and selling and buying and selling. They're doing everything wrong at the wrong time. And I think the reason, so in reality, a real business owner would never do what I was talking about, the car wash. That's not how they operate. In fact, it's a good thing that business owners, in my opinion, can't see what the value of their company is day to day. Sure, they know what their metrics are. They might know what their profit and loss is. They might know what their cash flow is and their overhead and all those kinds of things. They know at the end of the year what their top line revenue is, what their bottom line revenue is, what their EBITDA is. They know these things, but those small, closely held businesses don't have a stock return that they can look on their phone and see not just daily, but minute to minute what the rate of return is, for that stock, for that day or that week or that month or that year. And what I think would happen is if business owners could do that, man, they might be very much under the pressure of that crazy made up story that I told at the beginning, right? Now they may not do it because they understand more about how the intricacies of their business works, but that's how people treat their stock portfolio. And that's the exact wrong way to treat it. What investors should be doing, and again, I'm kind of preaching to the choir if you're a client of mine, but maybe you have young adult children who are just starting out. And what they need to look, or how they need to operate with their stock portfolio, their equities portfolio, is that it's a business in and of itself. That's how I view mine. So, Jamie and I, my wife and I, we've got a portfolio of 95% equities in our investment portfolio. And those equities they're global equities. We've got tens of thousands of positions. And I don't care necessarily how any one of them's doing. I don't even care really how the whole thing is doing, because I view that portfolio, I view that bucket of money as a quote unquote business. That's my business, holding all of those shares of all these companies globally. And whether that business is worth 5% more or less this year, or 10% more or less this year, or this week, is irrelevant. I am owning that business, that portfolio, that one piece for a long time, just like any business owner would. So if I'm going to go out and I'm going to buy a portfolio of car washes, or whatever it is, you see all these things popping up, these franchises, like sauna-based workout studios, or cycle studios, or coffee shops, or whatever, auto dealerships. It doesn't matter what we're talking about. You should be buying that business for a long term. That business is going to give you cash flow. It's going to give you rates of return that go up. It's going to give you rates of return that go down, but it's a business. That's where capitalism provides return to the investor, but only if you hold it long term. And that's the way your equity should be looked at. So this is just a short reminder whenever you see the news and you start getting a little bit skittish, I want you to come back and think about that made up story, right? About the guy with the car wash who bought it in January and then sold it in April. And then he's buying it high and he's selling it low. And then he's buying back in high and selling it low. And fool's game. It's a fool's game. We don't do that. We would never do that on a real business. And that's the way I want you to treat your portfolio, your equities portfolio with us. Now, does that mean we don't rebalance it? Of course not. Right? There's academic research that would show that we need to rebalance that portfolio, because if we don't, and it just continues to, what's going to happen over time is your equity positions are going to continue to grow, and your fixed income or your bonds, they will never keep up with the equities long term. And so over time, what's going to happen, you won't even know what's happening to you. If we don't rebalance it for you, your risk profile is going to get out of whack. You might come to me and say, look, I only want 60 or 70% of my money in the stock market. I want the rest in cash and bonds. And I say, great, but if I never reallocate for you, if I never rebalance for you, those equities are going to outgrow the cash and the fixed income over time. And you're going to go from 60 or 70% stocks to 80 or 90 or higher. And then when we do have a really bad bear market, you're going to have outside losses. You're going to have losses outside of what you would expect. And that's not what we want to do. So aside from rebalancing, whether it be quarterly or annually or what have you, because 401ks are different than the way we can do it outside, aside from that, we're not going to sell based off of short-term, economics or God forbid predictions from a journalist or somebody in the media or your super smart neighbor or your super smart, young adult son or daughter who's now on Robinhood and they're trading stocks alongside of betting on the current NFL game. That's not how we're going to treat your equities portfolio. We're going to treat it like a business. And so I just think it's a good little short reminder for you to refocus and recalibrate the way that you operate with that piece of your balance sheet.
Registered representative and financial advisor of Park Avenue Securities, LLC, PAS, OSJ 5280 Carroll Canyon Road, Suite 300, San Diego, K9212161964864000. Securities products and advisory services offered through PAS number FINRA SIPC. Financial representative, The Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary PAS or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC. TA Insurance License number 034103. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. Past performance is not a guarantee of future results. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile and less liquid than securities of larger companies. Investing in the bond market is subject to certain risks, including market, interest rate, issuer, credit, and inflation risk. Indices are unmanaged and one cannot invest directly in an index. This material is intended for general use. By providing this content, Park Avenue Securities, LLC, and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation or to otherwise act in a fiduciary capacity. 8634695.1 expires December 2027.